We're here with Wider Path Home Foundation, and we are talking about understanding lenders. Who are lenders? How do you work with lenders? Where do you get started? How do you find them? All of the questions that you might have about what it's like to work with a lender in your own area where you live. Welcome, and I'm going to turn it over to y'all.
Hello, everybody. Sean Delaney here. I'm joined by my colleagues and friends, Jeff Nelson, Jared Maxwell, Brian Gilpin, and then I think soon to be coming Greg Peel, if he shows up. We're here today to talk about lenders, types of lenders, how to find a lender, how to find a loan officer. And then we're going to go through some mortgage terms, such as the buyer, what a mortgage is, things like that. So when you actually go down and you sit down with somebody to get a loan, you actually know what that person is talking about, because a lot of times in a lot of industries, we have our own language, but we work with people who don't work in our industry. So sometimes we use that lingo with our clients and they really don't understand what we're talking. So we want to break that down for you. So if somebody mentions these terms, you have a better understanding. So first I wanted to introduce Brian Gilpin, and he's going to talk to us a little bit about the types of lenders, who they are, what they do, and why it's important for you to know about them. Brian?
All right. Well, thanks, Sean. So, we've got, kind of three types of lenders that are out there. I work in the secondary marketing department. And so we buy and sell loans from banks and then from the Embrace Home Loans side of things. And so there's a bunch of different people that you can do mortgages with. The first would be a broker relationship. Brokers are folks that work with multiple lenders. They can't actually make a decision to give a buyer a home, but they can work with the lenders to make that happen. The second would be, kind of your traditional bank. And, there's a number of different really large names out there that you probably see a lot of commercials on, and where you might actually have a bank account, checking or savings account. They do all kinds of different types of transactions. They would be called depository bank, and so they might do your banking as, like I said, savings and checking, but then they also do mortgages, maybe car loans, home equity loans. And then the third main type of lender out there is what you would call a mortgage bank, which, which you three guys are all work as originators as a mortgage company at Embrace Home Loans, and focus solely on just doing mortgage transactions. So you're trying to help folks either buy a house or to refinance a house to get a lower interest rate, or maybe take equity out. And so the focus, you got one line of business, it's about mortgages, and it's about doing those types of things. But I think the most important thing is, no matter what type of lender you're using, it's really trying to figure out, who is the lender, and then ultimately the loan officer that you're going to work with, because there's a lot of great loan officers and there are a lot of great lenders out there. And so you got to find the right person, the right connection for the people that you want to work with.
All right, fantastic, Brian. So we talked about lenders, and I think more importantly, is the loan officer. So I want to pass this to Jeff Nelson, who's a loan officer himself. And we heard from Charles and Mo in the last segment talking about finding the right realtor. So what's important about finding the right loan officer, Jeff?
Hi, everyone. Thank you for having me. Now more than ever, many people are starting their journeys to become homeowners and investors, which is incredible. With the team aspect that we've been talking about lately, that's exactly what you need to go do. You need to go build your team. The first player on your team is finding that right lender. You want to find a lender that you can trust. You're dealing with your finances. You're looking to qualify for that loan to purchase that property. So you want to make sure that that lender understands the type of programs that you're seeking in. They have that experience, and that can just walk you through the whole process. As everyone knows, the home buying process is an emotional roller coaster for all parties involved. So you want to make sure that when certain hurdles or things that come across, that you feel confident the team that you put together can handle these things. For the main purpose is that we qualify you based off your gross income. We look at your credit report. We look at your savings, your bank accounts. All those things go into category where you do get your pre-approval that allows you to go work with a realtor. But you also want to be in a situation where you feel confident that it's affordable. There's a big difference between eligibility and affordability. As Chris mentioned earlier, yes, We're looking at your gross income. We're looking at what you actually qualify for, but we don't take into account for your childcare expenses, your phone bills, things of that nature. So making sure that whatever payment that you do have, whatever home that you do qualify for, is something that you're affordable, because we want to make sure you stay in that home. So having someone that you can trust is putting you in the right position, explain things as they come along, and connect you with a realtor that you can trust as well to do that job, is very important. Understanding your taxes, understanding your insurance, what does that all means, understanding DTI. These are all foreign things to you, you never heard before. So having someone that can guide you through that process and take the blindfold off, because that's exactly what it can be. It can be very overwhelming. You don't know like what's going on. So we remove that blindfold for you, and allow you to see the whole version, the whole process, step by step. It's very crucial making sure you work with someone like that.
All right, fantastic. Thanks, Jeff. And you could have led us into a perfect segue with asking Jared to break down some mortgage terms for us. So Jeff had just mentioned DTI, gross income, and all the things that go into putting a loan together. So when you go to talk to a loan officer, you're going to want to know some of these terms, and Jared's going to walk us through some basic terms so you understand what the loan officer is actually saying to you. So Jared, please take it away.
Sure. I'd like to introduce some mortgage terms to you, specifically mortgage, borrower, debt to income or DTI, loan to value or LTV, and down payment. So if we start with the mortgage, a mortgage is a loan that the borrower uses to purchase or maintain a home or other form of real estate and agrees to pay back over time, typically in a series of regular payments. The most common mortgage terms are 30 years or 15 years. When you're borrowing $300,000, extending that over 30 years allows you to pay it back in smaller payments. The property is what serves as collateral to secure the loan. When we talk about a borrower is simply the person legally responsible for paying back the loan. Oftentimes, there will be a borrower and a co-borrower on a loan when there's two people purchasing a home. Next, we're going to jump to the term debt to income, which is often referred to as DTI. And that is simply your monthly debts compared to your monthly income. So for example, you might have a mortgage that is $1,500 a month, and that includes your taxes and insurance, a car payment of $400, and a credit card bill of $100. So that comes to $2,000 of debt payments a month. You would divide that by your income of $5,000 a month. 2,000 divided by 5,000 is 40%. So your DTI in that situation would be 40%. Now, some other things that are included in your DTI would be things like monthly child support or alimony payments. Things that wouldn't be applied to your DTI would be, electricity, your cell phone bill, your cable bill. Those aren't counted as part of your monthly debts. So if you wanted to just do your own calculation, you'd take your monthly debt payments divided by your monthly income, and that's your DTI. The next term is LTV, which is referred to as your loan to value. And your loan to value is simply your loan amount or how much you are borrowing divided by the value of the house you are buying. So if your loan was for $285,000 and the purchase price of your home was $300,000, your LTV would be $285,000 divided by $300,000, or 95%, an LTV of 95% in that scenario. So the $15,000 that is the difference between the $285,000 and the $300,000 would be referred to as your down payment. Your down payment would simply be the amount of money a borrower puts down or deposits towards purchasing a home. Your closing costs are the fees and charges that you pay associated with the closing of a real estate transaction over the property's purchase price. So examples of some common closing costs include an origination fee or an underwriting fee. Those are fees charged by the lender. There's also fees that are charged by the title company. And those are fees such as a recording fee, a settlement fee, a title exam. And there's also other fees which are really referred to as escrow, which might be the amount that you're holding for your insurance or taxes, or any taxes or insurance that are due at closing. And so when we talk about a monthly mortgage payment, there's a phrase thrown around called PITI, and that simply is your principal, interest, taxes, and insurance. Your principal is a portion of the payment that's dedicated to repayment of the principal. So when you take a 30-year loan, your payment might start at, let's just say $1,500. And of that $1,500, the principal and interest portion of that could be $1,200, and $1,000 could be going to interest, and $200 could be going to principal. The amount of your principal payment will increase with every payment over the term of your loan. The other piece of that is interest, and interest is the price you pay for borrowing money. And it's really the lender's reward for risking its funds on you. Mortgage payments in the early years of the loan are applied more to interest than principal. The ratio gradually shifts as time goes by. So if the interest rate on a $100,000 mortgage is 6%, the combined principal and interest payment monthly on a 30-year mortgage would be $599.55, of which $500 would go to interest and $99.55 goes to principal. And then you also have taxes and insurance. Taxes are the real estate or property taxes assessed by local governments, used to fund your police, fire, and schools. They're calculated on a per year basis, but you can include them as part of your monthly mortgage repayments. The lender then collects the payments and holds them in escrow until taxes are due. And with insurance, like real estate taxes, insurance premiums can be paid with each mortgage installment and held in escrow until the bill is due. And there are two types of insurance coverage that may be included. One is homeowners insurance, which protects the home and its contents from fire, theft, and other disasters, and PMI, or private mortgage insurance, which is mandatory for people who buy a home with a down payment of less than 20% of the cost of the mortgage. And PMI is paid to the lender. When you pay your principal, interest, taxes, and insurance in one payment, it's referred to as making your payment with escrows. It's something I personally prefer. I like to pay it just monthly, and then when it's time to pay the insurance bill or the tax bill, my lender sends that payment, and I really don't have to do anything. Other people prefer to make those payments on their own and just pay principal and interest with every payment.
I wanted to add another portion to the closing costs. Phenomenal information, Jared. Thank you so much. A lot of times where people would hear that all you have to do is put 3.5% down on a first-time home buyers or 5% down, that portion does not cover the closing costs. So that's an additional fee that you have to pay to cover those things up.
Can I ask one quick question? Can you just explain escrow again, in the sense of what does that mean to put something into escrow?
Sure. So when you calculate your taxes or your insurance, let's say that your annual insurance, homeowners insurance costs $1,200. And so you normally pay that when you purchase a home, you pay it for the entire year, but it's going to renew in 12 months. So you're planning for it to renew at a cost of $1,200. And so you're paying $100 a month in your mortgage payment, so that, when 12 months pass and it's time to repay that renewal, there's going to be enough payment in the escrow account. Actually, many times, most lenders actually forecast the payment will go up 10 or 15%. So they have you hold a little bit more, so there's not a shortage. The same thing with taxes. If your taxes are, let's say, $6,000 a year, they're holding $500 every month included as part of your payment. So that if your taxes are due annually, you're not writing a $6,000 check out of your bank account. Instead, you've paid it every single month and you've budgeted for it. And it really allows you to manage your finances a lot easier.
Essentially, it's really a savings account for your home with the escrow balance. So that money put aside, as Jerry was saying, if a portion of your tax and insurance is $5,000 for the whole and total year, every time you pay your monthly payments, that portion is going to that savings account, and then we pay for it directly. You don't have to worry about it. If there's a change in it, we'll send you a notification and say, hey, your taxes are going up slightly, so your payments are not going to be adjusted, maybe $50 more. But essentially, that portion is in the saving accounts that we put aside for you, and we take care of it for you.
So I might just end up making one payment, and it's all of that rolled in, but you're handling that for me, and it's no different from going from renting to mortgage. I'm just making a payment, and it's all
PITI.
It's a great tool to budget, because most of us are not that disciplined. To really set that aside every month. And so that can be, it could be a very scary thing for you, because all of a sudden, particularly if your tax bill's due and you haven't budgeted for it, that can be a lot of money that you might not have in your bank account. So it's a great tool, particularly for a first-time home buyer, as you get used to what those payments are going to look like.
Thank you all so much. This has been so incredibly informative. And just want to encourage our viewers as well. All of this information, we have other videos on Wider Path Home Foundation on our Facebook page. You can go to previous events and find video recordings as well of our previous sessions. We've covered budgeting and savings. We have covered home ownership in the sense of understanding your credit scores, credit agencies, everything you can want to know about credit. We've started you down that path, but most importantly, we have connected you to housing counselors in community development corporations in areas where we're located, but we've also helped you think strategically about how to find community development corporations and housing counselors in your areas. And that will be our next session as well. So thanks so much for being with us today, and we look forward to seeing you next week. And thanks again for all of your input. We are so grateful for everything that you brought to our platform today, team. And we will end now. So have a wonderful evening.